Welcome to the Divorce and Real Estate Podcast, where we navigate the complex intersection of divorce and property.
Our mission is to provide crucial insights, expert advice, and empathetic support for those facing divorce and real estate decisions.
Each episode will provide you insight into the specific challenges and opportunities available
for your real estate during the divorce process,
along with expert advice from leading professionals in the field. Thanks for joining us. So welcome back, everyone. And this is going to be episode 2. We are talking about creative solutions for what to do with your house during your divorce today. So we're going to be covering selling your house, refinancing and keeping your house, or keeping your house as a joint property, such as an investment property, which is kind of a rare option, but still an option.
I'm excited. Let's do it.
So let's start with selling the house, because that's something that we are both taking part in during the process. So I always tell my clients, selling your house is the cleanest way to get rid of your house during your divorce process, because the market is then going to determine the value of your home versus having to get a valuation for it. And so that's going to be really helpful, because otherwise you're really taking a risk keeping the asset. It could go up or it could go down. So Asher, I'd love to kind of hear your perspective on the market and what that would look like for an ever-changing growth or loss on a house.
Yeah, well, I think one thing you hit on the head already in regards to like, what is it really valued at? Because that's the biggest question the spouses are trying to figure out, right? Like if someone's going to buy someone out or not, they want to know what the value is. And by marketing it and getting it on the market, getting it ready, the buyers, known as the market, are going to tell them what it's worth, right? The writing will be on the wall. We'll be able to see what it's really valued at. Doing that process before that and coming up with, CMAs or comparable analysis or getting an appraiser over there, always is not the best solution to figure that out, right? If you're open to selling it, let's get it sold. So we'll do the whole thing, right? We're going to get it ready and we're going to get it on the market, and then we're going to present the offers and feedback to the owners. Today's market is definitely a blend of, there's demand in the marketplace. So if someone's going through a divorce process right now and they want to, what's happening in the marketplace today, the blend is there's demand, but there also is definitely negotiation that's happening. So we're not experiencing the crazy seller's market that we did just a few years ago, where you put your house on the market, it sells in a very short amount of time, and you get over asking price, and the buyer waives the right to do any inspections, things like that. So we're not in that mode, but we're not in a mode where people are accepting offers $100,000 less either. So depending on where your home is, depending on the current condition of your home, it's definitely going to be maybe an even playing field for you. And we just have to do everything properly to make sure it's marketed and presented properly.
You bring up a lot of good points, because that's also why it's really helpful to sell the house. Because, for instance, if you sell the house and then you have an inspection, you're going to know if there's issues with the house. Let there be something substantial, like structurally, or just kind of cosmetic things that need to be fixed. And you're also just aware of what are those expenses that it's going to cost to actually sell your house, closing costs, title fees, because those are things we have to guess at if one of you keeps the house during the divorce process. We kind of have to run a rough estimate, but we can't really know that if you don't go through the full process of actually selling it. So if you keep your home, we're really playing a guessing game, where if you sell the home, then at that point, it makes it a lot cleaner. So we know exactly what all those numbers are going to be. What did you have to pay for maintenance or upkeep or repairs that you had to make because of the inspection? What did you pay for closing costs, title costs, all of those pieces? It's easily fleshed out, rather than we're guessing at those things and now you're taking the risk as the person keeping the house that those numbers were relatively accurate.
Yeah. And I think that one person in the situation where someone's buying the other person out, one person always sometimes feel, not always, but sometimes someone feels like they didn't really get the best deal. Like they're thinking like, what if we actually listed this thing or, put it on the market? I wonder what that would have looked like. And, this way, this is just definitely a cleaner way to do it. But
Yeah.
let's go down that road. Like, what happens if someone's like, I want this property and I want to stay there, and you know, the other person's okay with being bought out? We can still do that inspection process. You can still do those
Mhm.
functions of a transaction, by going down that way. It just might not be as clean as both people saying let's sell it.
Yeah, I think the biggest thing is first thing is a lot of people say they want to keep their house. And I always tell my clients there's an emotional attachment to a physical asset, and then there's an actual financial obligation of keeping that asset. So for a lot of people, very understandably, like it's where their kids had their first steps, or it's where they had a big event in their life, or it's where they feel secure or safe. And so they want to keep that, or they're like, my life is changing so much. I'm going through a divorce. I'm going through these changes. I also don't want to sell my house, which is completely understandable. But a lot of times then we forget about the financial implication of keeping a home and one person having to afford it. And so the first question always for me is, can you financially afford to keep the house? Because if you can't, then we're just putting people in bad situations. As a CDFA, I've had a lot of people who've called me where I didn't help with their divorce, but they call me a year and a half after their divorce and they say, oh, I saw that you help with finances and divorce. My agreements don't work. And it's like, well, they don't work because you didn't look at these numbers at that time. And so I always try and help my clients understand there's a difference between what do you want to do in terms of your emotional connection to your house, and then what do you want to do financially in terms of your house. Because selling your house or keeping your house is a big emotional decision. You have to deal with those emotions with your clients every day.
Yeah, and what about when someone is, wanting to, I guess, what's the first big step that you walk them through? Like before they even get, let's say, to me to help list a home or doing comps
Mhm.
or whatever it might be, what's the first thing that you're helping them with? Like, how do they find out if they can really afford this home? What's something you do?
Yeah, so two big things. First, I know that it's everyone's least favorite thing to do, but a budget is really helpful. So, I mean, a lot of people just in everyday don't budget, but it becomes really, really important when you're going through a divorce, particularly because I always tell people you're going from one household, one set of utilities, rent, mortgage, one, to now two of everything. And so it doesn't mean that your expenses are going to double or your income needs to double or anything like that, but your expenses are going to go up. So first up is, what are you anticipating your expenses to be? Even if it's going to be a guess, even if you jump on Zillow or Redfin and look at like the area you want to live in and the size of the place you want to live in, and what are generally the costs that are associated with that. And then the second step is a deeper dive, is having someone actually run an analysis of if you can afford to keep your house on your own. And so that's usually going to be a loan officer, a mortgage broker. There's also people that are called certified divorce lending professionals, and they essentially run all the numbers to see if you could qualify for the house by yourself. And so there's the logistics of, first, can you qualify? Second, can you afford the day-to-day expenses? Because we never want to see our clients be house poor, where everything is stuck in the house and now they can't do anything outside of the house. A lot of people don't realize that. They kind of see it as like, oh, well, my equity or the portion of the house is $250,000. So I'm getting $250,000. It's like, well, you're not getting $250,000. You're getting a house that has expenses. So I always try and really help my clients understand your house is more of an expense. Sure, long term, it's an asset. It's a place of security. It's a place of safety. It's a place of really kind of home and where your life is. But on a day-to-day expense, we need to be able to actually afford those expenses. So initially in our office, we're always looking at, can you afford it on your own on a monthly basis? And then can you also qualify for the mortgage or any other loan that's associated with it by yourself? Because otherwise, there's not really any point in putting in an agreement that you can keep the house if you can't, from a financial perspective.
Yeah. And another thing that we like to, help people with is just having them talk to their, CPA or,
Mhm.
about what happens when they sell the home. Is
Yes.
there going to be a capital gains tax? Is there going to be something that they have to be aware of? Because like you mentioned, the $250,000 of equity, well, I'm going to just get all that and do what I want with it. Well,
Yeah.
really? Like maybe not. And we need to make sure that we're, coaching them along and helping them see the entire picture through. Because
Mhm.
the short-term picture is definitely, we let's say they own nothing on the home and it's a $500,000 home.
Yeah.
So they're thinking 250, 250. But what does that look like after a tax, event that they have to pay on or
Mhm.
everything else? So really breaking everything down and to the end, right? Like, how do we really forecast this through?
Yeah.
And are you looking at all angles before making that final decision if you're going to keep it, buy someone out, or just sell it?
And there's a lot of tax implications too, because you have to think you have a higher capital gains threshold as a married couple than single. So when are you selling the house, and are you going to be married or single in that given year? And if you're going to be single, is it drafted properly in your divorce decree saying that you are splitting the capital gains so that one of you isn't responsible for them? There's just a lot of pieces to be considerate of. And unfortunately, a lot of times what we see is just general agreements that say, spouse one is going to keep the house, they're going to give the other person X amount of money, and then that's it. And there's just not a lot of conversation of, well, what does it look like to keep your house? I had a client recently who has ultimately decided to sell their house, but was contemplating keeping the house until they realized there's a ton of structural damage and all of these issues. And it's like, well, that's a big deal for you to be keeping something that you're not going to be able to afford to get to a condition in which you should be living in it. So, sure, it seems great that you have a house, but you're living in a house that could fall on you at any minute. So, that's not a great option. Or just looking at those long-term issues. So, when we're talking about a buyout for a house or a buyout for any physical asset, I always explain it to clients as if you have a physical asset, the only way to buy it out is you keep the physical asset, you give cash to the other person. And there's a separate part of the tax code that says that money that's paid out is tax exempt. So the payout to the other person's tax exempt, but you still have all the tax implications that's associated with the physical asset that you held on to. And so people don't realize that. I always say money between you is tax exempt. All other taxes that apply to anything stay the same. You don't get to avoid them because you're going through a divorce. So you need to understand that. But there's also these little rules. So for example, there's a part of the tax code that says the buyout should happen within 7 years or it can start being taxed. Well, we see agreements all the time that are over a 10-year period. Well, there's the possibility that 3 years of that you just got taxed on and you didn't need to. So it's just really important to understand all the little intricacies that go on with that, because ultimately those are going to have an impact on what the house value actually is, or what the buyout's going to be worth, or what your tax implications are going to be at the end of the year. There's just so many things that are associated with a house.
All right. So just so I'm getting it right and everyone else listening is too, the tax implications can vary depending on if you're doing a buyout, if
Yep.
you're just selling it. One spouse could take all of the responsibility,
Mm-hmm.
or it's divided in two.
Right. So it completely depends, but it needs to be drafted properly in your decree to actually demonstrate that. And a lot of times it's not. So technically, neither of us can provide tax advice. Always like to clarify that. But it's really important to work with a tax advisor. I always tell clients, even if you do your own taxes, work with a tax advisor the year that you get a divorce, because that's going to be the year that's going to have the biggest kind of roller coaster of what applies and what doesn't. But it is really important because it's going to vary. And so if your documents aren't drafted properly, let's say you do your taxes separately, well, one CPA could assume one thing and one CPA could assume another, and now you're getting audited. We don't need to do that. So it's really important that you're not only talking about selling or keeping your house, but what are the taxes associated with that and how are they handled? Even if you don't know what the taxes are going to be, we still need to allocate them properly. Who's going to be responsible for what, or who's even going to get the benefit? So for example, who gets the deductions for the mortgage and the insurance that you paid for the year? Who's going to get those pieces on their taxes so you don't double up and get audited by the IRS? No one likes that.
And that's what you're helping people figure out, right? I mean,
Right.
it's not always a fighting room situation where you would easily be able to help them and say, hey, it might make more sense for this person to get that benefit, and then you get this benefit based on income levels and or whatever it might be.
Right.
And that I think would be so helpful for people in this situation because, right, their mind is already kind of racing and all over the place. And,
Yeah.
and you helping them make those decisions and getting that decree moving forward so that they can, make the right moves after that. And I think sometimes people are coming to me before you and saying, hey, we're thinking about getting divorced and we want to know what our home is worth. Well, hold
Mm-hmm.
on a second. Before we even get to that point, why don't you, speak to Kristyn and figure out how you're going to be doing things. I can definitely run comps and provide a value in today's marketplace,
Yeah.
but get that decree going and see what makes sense for the whole picture.
And that's why it's super helpful for more of a collaborative process, because a lot of times it's either they come to you and then they come to me later, or they come to me or another divorce professional, and then they come to you way after everything is finalized. And so that's where our process is really collaborative together and talking through those points when they actually happen. So when we have a client together, and maybe their divorce isn't finalized, but you need paperwork to be able to get the home sale rolling, or the loan officer needs to refinance rolling, we can have those conversations instead of them not being able to get the new home that they want because they don't have the right paperwork or the timeline is off. And so I think that's a really big benefit that a lot of people understandably don't understand during the divorce process. Is they're like, I just need to go through the process, but they don't recognize the major financial implications that will happen during it. And so for a lot of clients, we're looking at things, and I had clients recently, they had a document prepare their documents. And they came to me and said, oh, can you just look them over and see that they're right? And I get that they didn't want to have to pay a lot for the service, but it was a lot of money that they were going to lose. They were leaving a lot of money on the table because they weren't drafted properly, and the money was likely going to get taxed, and it didn't need to be. And so it's one of those things where there's a lot of these kind of little tricky points that obviously people just don't understand. I mean, I don't understand the real estate process. That's why I have a you. So
Right.
it's having that professional that knows those details because you don't know them yourself, which is expected.
Yeah. So if someone is watching this and they're like, all right, where do I begin in
Mhm.
regards to this whole thing? In my opinion, start with you
Yeah.
before starting with me. I'll definitely jump in at the right time, but definitely start with you. Start that process. Meet with them, right? And then when they kind of know what's going on and how they're moving forward, not if they're going to buy someone out or sell or keep it,
Right.
not that part yet, but just the part of like how they're handling their divorce. I think that is probably best to do up front, and then figuring out the real estate piece, because it's not always, a piece of real estate that they're living in. It could be that they have a
Right.
portfolio of rental properties, or they
Yeah.
have a commercial building that they both own. And that's something I think that we haven't really jumped into yet, that I think we can kind of go down that rabbit hole if you want right now. Like,
Yeah.
what does that look like from your perspective if they own rental property or investment properties?
Yeah. So for investment and rental properties, it really depends. So for some people, let's say it's a commercial building that's associated with a business. So like they own the commercial property, it's associated with the business, they're the one that's keeping the business, they're gonna buy out their spouse. In that case, that commercial property is likely going to be lumped in with the value of their business. What is the value of everything they own for that business? They buy out the other spouse. What we more likely see though are people that just have like an investment property here or there. It's not set up in a business structure, or they have a second home. And so the question is, do you plan on maintaining these things jointly? Or do you plan on selling them? Or do you plan on one of you keeping them? Because for each of those items, we need to look at them separately. And again, different tax implications. So for a lot of people that have investment properties or even second homes or different things, they're depreciating them. That's kind of a very different impact on your taxes. And your CPA has to give us exactly the right information for what that's going to look like, because it's not just run-of-your-mill everyday primary home. But it does get interesting in if you choose to keep stuff together. If you choose to keep things together, then we have to talk about actual usage of that property, maintenance of that property, and who can live there, for example. So it's one thing if it's an investment property and you have a renter in it. Maybe you choose to keep it jointly. You're going to share the maintenance costs. You're going to share the income. But what if you own a property like a second home, like you have a cottage in Payson? Then we really need to be very specific about usage of the property. So for many people, what they'll do is they'll split it up. So 6 months out of the year, one person gets to use it, and 6 months out of the year, the other person gets to use it. So we're not all there at the same time, causing conflict. Or, you both choose to celebrate Christmas there. We don't want those pieces to happen. But there does need to be, regardless, definitely a layer of trust between the two of you. Because in a divorce, trust tends to be the first thing that dissolves in a relationship. And you need to have trust if you're going to retain something mutually, because you need to trust that, the other person's going to keep it in the condition that you want it kept in, or that they're going to pay for the maintenance fees, or that they're going to take care of whatever role they chose to take care of with the tenant. So
What
there
do you
has to be a
what
lot
do you
of
see most of the time? Are you seeing we're gonna sell property, we're gonna keep it between us, or the buyout? What are you seeing?
Number one is buyout. Most people want to keep their house and they buy out somebody else. These are my fun Zoom things, by the way. Second is going to be sell. Third is going to keep mutually.
Okay.
And there has to be a level of trust there, and a lot of people don't have it, completely understandably. So keeping things mutual is not common unless it's for a business. Like you own a bunch of properties that are all rented out and you're not going to use any of them together, and you choose to retain the business jointly. But most people are going to choose to do a buyout just because someone wants to stay in the home. A lot of times it's for kids. Like we just want to keep our kids in the same space. So with the buyout, I think the biggest thing that comes up is valuation. And I would love to hear your perspective on online valuations like Zillow and Redfin, because I have a personal feeling.
Yes. I love those. I mean, that's usually the first thing that I'm being told when I go and meet with someone about their home value.
Yeah.
They usually have Zillow open or they have it printed out, and they're like, well, this is what Zillow says, so can you do better? And I'm like, well, hold on a second. Let's figure out what Zillow is doing or online,
Yeah.
right, valuations are doing.
Yeah.
And
Redfin, Realtor.
all of yeah,
Amazing.
they all have their own algorithm. And I think what they're doing, if you're in a master plan community with a
Mhm.
lot of the cookie cutter feel, I think that overall they're going to be pretty close in today's market. I think they're
Yeah.
going to be close. What those online valuation tools don't know are the upgrades and the enhancements that you've done to the property. So
Mhm.
them not or the deferred maintenance that you might have on your property and the things that are broken. So it goes both ways in regards to that. But I would say for the cookie cutter big master plan communities, it'll be within, let's call it 5 to 10%. I think it'll be pretty close. When you have more of custom homes, right? Paradise Valley, for example, or Cave Creek, a lot of beautiful, larger homes, very custom on acreage. I think that those algorithms just don't work very well for that.
Yeah.
And that's where you need a true professional to come in and really showcase, how to compare properties, how to value properties, etc.
And I really want to highlight a professional coming in because I cannot tell you how many people will say, well, I got a comparative analysis from a realtor. And I said, did they come to your house? And they just look at me. And I'm like, I mean, you can only do so much with what you know off of your computer and seeing what they have versus actually walking through it. And so really having that personal touch of someone seeing your house for the upgrades or the maintenance issues or all of those pieces to really know what the actual value of your house is. I always tell clients, if they absolutely want to use Zillow or Redfin and they agree to it, totally okay. But the court's perspective, if you go through litigation, is commonly they want an appraisal done.
Yep.
And what they'll end up doing is they will just get tons of appraisals until they get a number that they want it to get close to. So my rule of thumb to avoid we're going to just keep getting them until it gets to the number we want is I always tell clients, we're going to pick 1 or 2 professionals, whatever you would like. You have to agree on them. They will then run the numbers, and then those are the numbers we are working with. So that way we're not doing this like shopping for whatever price until it finally comes up the way that we want it to, because the market can do a lot of different things when we're trying to value things.
I really like the fact that you said that they just kept getting appraisals done because it's funny, right? Like that appraisal process, you have someone that comes to your home, you have an individual that specializes in valuation of real estate. They
Mhm.
come to your home and they give their value, and then they have another person that comes in and gives their value, and they're all a little bit different. And like we started with this whole episode, where it's really the buyers in today's marketplace that really determine what the home is worth. You
Mhm.
can have 10 real estate professionals, you can have 10 appraisers, and you can have kind of a ballpark number, but they all might be a little bit different.
Yeah.
And for someone to really know at the end of the day what their home is really worth in today's market are really the buyers that are willing to, write the
Yeah.
check.
And I always like to just emphasize to clients how important that valuation is, because when we're looking at a buyout for a house, kind of the general clean way to describe it for our viewers is we take the fair market value, we subtract out any and all loans. So that could be mortgage, home equity line of credit, HELOC. It could also be like a lien for solar or pool or something else against your home. And then that gives us the equity. And then because we're a community property state, we typically divide that equity in half, and that gives you your buyout. But obviously that fair market value very much changes that final number. If your fair market value is 200,000 versus 300,000, that's going to have a big impact on that final number for the buyout. And there's a lot of argument for, well, should we also look at potential closing costs or potential fixes or maintenance that needs to happen to get the house to where we want it to be? So there's never a set number. I always like to explain to my clients, it's like a realm of reasonable. It could be like on the high end, the low end, but again, it's very much a guessing game because we're not relying on the market to actually determine that value.
Let's go into buyout, right? Someone, 2 people, they own a property. One person wants to buy out the other, but that person doesn't have like liquid cash to
Yeah.
buy out the other.
Yeah.
So, what are some ways that we want to express today and make sure people are aware of? You mentioned HELOC, home equity line of credit, just now.
Mm-hmm.
I personally am a big fan of HELOCs. It costs really nothing to get,
Yeah.
right? They're usually fast to get on timing wise, and it doesn't affect your first mortgage. Like, it doesn't do anything with it. So
Yeah.
I like that route. What are some other ways that you're seeing the buyouts happen?
Yeah, so I like to have them kind of do a comparison with the loan officer that they're working with. So home equity line of credit can be really helpful. My funny home equity line of credit is people either know it as a home equity line of credit or a HELOC. They never know that they're equivalent. So I always ask my clients if they have both, because without a doubt they will have one, but they don't realize they're the same thing. I don't know why. Everything else is fine, but those two just do not connect. So same
They're the
thing,
same
but
thing.
they're the same thing.
That
But
is what it is. Yeah.
it's actually, if I have it listed twice on my documents, and someone in our office was like, "Why do you have it listed twice? Isn't it the same thing?" I'm like, "Because it just doesn't connect, and people will forget it if I don't put it twice." So funny HELOC story. The things we find entertaining in our field. So with a HELOC, it can be really helpful because it's not going to impact your interest rate on your home. Instead, you're going to pay an interest rate just on that amount that you took out. It really depends on how much you need to take, though, and how much of an impact that's going to make on what your debt is going to be that you owe every single month for loans. So a home equity line of credit can be really helpful. Second option is a cash out refinance. So refinancing your home, taking the cash out to pay to the other person. That means that the loan that you had and the cash out portion is now going to all be at a higher interest rate, though. So just being aware of that. With a cash out refinance, there are actually special cash out refinances for people going through a divorce process that allows you to take out more cash than you would in any other cash out refinance traditionally.
Hmm.
So that's helpful to know. It's a spousal buyout refinance instead of just a traditional cash out refinance. And only about half of mortgage brokers or loan officers will know to bring that up. So I always tell people be aware of that. And then the last one is a buyout over time or delayed buyout. So some people will say, for example, well, my kids are graduating in 2 years. I want them to just stay in the school until they graduate. And the other person is agreeable to getting the cash once they sell the house when the kids graduate. So there's a potential for that. I try and stay away from that if we're over like a 2-year term, because life changes and you want cash. So you want to be able to buy your own home or find somewhere that you want to live. And then we can also get creative with like the division of assets. So you keep the house, but the other person gets a bunch of other assets. Let that be more in retirement, more in liquid assets like cash, more in other assets that you own. Like, I'm going to keep the primary house, but you get the 2 rental properties instead. So if they have quite a few assets, we can get creative with parsing those out. And kind of another creative option is in the form of support. So in Arizona, we call alimony spousal maintenance. So some people will just raise their spousal maintenance amount or lower their spousal maintenance amount. So let's say the person who is going to be keeping the home is the person that's receiving spousal maintenance. Maybe they agree to take less spousal maintenance and they don't have to do as much of a buyout. So there's a lot of creative options, but we just need to be cautious of, as each of these items has an impact on the other. So as an example, spousal maintenance and child support can be used as income to qualify for a loan or for a home. So we don't want to lower that if we need it to actually qualify. And that's within a certain term, so it has to last for a certain duration for it to actually count. So we just want to be cautious that we're not taking one away to benefit the other, but then it's going to have an impact on something else. That's what we talked about in that first episode, all the puzzle pieces, they all have to fit together. So if we move one piece, we have to make sure we didn't just mess up the rest of the puzzle by doing that piece. So there are a lot of creative options. It really just depends on the financial circumstances of the individuals that are going through the divorce process.
Yeah, looking through just this episode, we've unpacked a little topic, but there's so many moving pieces
Yeah.
to how to figure out what's the best thing. And it's not us coming up with it. It's, I think, really just laying it out for them, for you to really help them see the whole picture.
Yeah.
But knowing there's more than one option, because I've come across many people, I'm sure you have too, they're getting divorced and we have to sell the house.
Mm-hmm.
Right. And that's not the case, right? We're
Yeah.
showing today that there are many different options of what you can do with your home. You can keep it, buy someone out. You can both, move out and move on and, sell it and rent or buy something else individually. So, I think today was good just to kind of showcase the different solutions that there are for people going through divorce.
Yeah. And I think another piece to consider is you mentioned it in the first episode, like that you'll tell people not to sell their house, like if they can keep it as like a long-term investment. Ultimately, if that's an option, that's great. We don't want people to have to sell things if they don't need to sell things. But if they're going to retain them, we just want to make sure that they're doing it properly in terms of taxes or maintenance implications and all of those pieces. But I have a lot of clients who will keep things. Like I had clients years ago who owned an apartment building and they decided to keep the apartment building jointly as a business. And it's been very successful for the two of them. And so if we'd gone down that route of like, oh, we just have to sell everything, sure, maybe they may have reinvested that and it might have been a good investment, but they both had made a good investment in the first place. So if we can avoid offloading stuff as much as possible, I don't know. I don't love the courts process, which is traditionally just chop every single thing you own in half. It's just not realistic. And so if we can be creative and keep as much intact as possible, that's gonna be really beneficial. Even not on a home basis, but like retirement accounts, some of them have a cost for dividing them. Well, why don't we just avoid the cost and keep them whole if we can? Just try and prevent as much of the splitting as we can if it's going to be a long-term investment, because as you talked about, that can be really beneficial for people in terms of their net worth or their goals for the future financially.
Yeah, and I think a lot of that has to do with either their upbringing or if there's kids involved and there's generations and I think the biggest thing too about when people are going through divorce is a lot of financial stress. And
Mhm.
if someone bought a home 10 years ago, and with the lower interest rates and they almost, they paid a lot of the home off, thinking of like restarting that a mortgage, a 30-year mortgage, like it just
Yeah.
everything just seems daunting. And yeah, sometimes just keeping it and living in it makes sense. But then there's a lot of people that say, I can't live here. There's too many, like you mentioned today, like there's too many emotional, like the memories. I just want a fresh start
Yeah.
and I need to make a move. And
Yeah.
so what weighs more? Like you have to weigh those pros and cons right there.
Mm-hmm. But that's really what you should be doing is I always tell clients we can't just look at tomorrow, next week, next year. You really have to be looking at what are your goals for the future when you're making your decisions now, because your decisions now, not meant to be scary, but are going to impact your finances into the future. And so you really have to think about what do you want to do in terms of your finances long term. And so what decisions are you making now? Because as you said, I mean, divorce is a reaction that tends to be very survival mode. And so people kind of go into survival mode and they're like, well, I just have to hold on to what I have, or I just have to get rid of everything and run. And it's a normal reaction. I really want to highlight that that's something that we see across the board. But that's where we have professionals step in and be able to give options and structure so that then you can know what your opportunities are to move forward rather than feel like you only have one way or the other. It's not black or white, it's a whole skew of colors. So we want to figure out where it's going to work best for you.
Based on what you said about the choices we make and tomorrow and things like that, I have a quote for us today.
Okay, I like it.
All right. So James Joyce said this: I am tomorrow or some future day what I established today. I am today what I established yesterday or some previous day.
Couldn't agree more.
It's good.
Yeah. Yeah. It's also good for the new year.
There we go.
Well, I think that's a lot of information that we went over today, and we'll be back again with another episode. But if you know of any topics that you're interested in or you want questions answered, please feel free to comment on the video with those so that we can address them in future episodes.
Yeah, and if you know that this is great information for someone, obviously feel free to share it with them, and always open to hearing your feedback.
Have a great day, everybody.
See ya.